Hello, and welcome back to another episode of the Collective Clicks podcast. This is your host, Brandon Bateman, and today I'm joined by Chris Prefontaine. Chris specializes just in creative finance, and we talk about some of the strategies that they use and how, in his opinion, creative finance is a lot more attractive than wholesaling or flipping. Chris, welcome to the podcast. How you doing?
I'm awesome. Thanks for having me, Brandon.
Yeah, super excited for you to be here and to get to know you a little bit and understand, your unique perspective on real estate investing. So for those listening that aren't familiar with you and your background, would you mind just sharing, a little bit of your story and what you've done and how that's kind of led you where you are today?
Yeah. So I've been at this 33 years. So for the sake of protecting their time and putting them to sleep, we'll do this quickly. I'm from New England. I can go quickly, Brandon. So yeah, I've been at this 33 years. I will tell you that I've touched a lot, not all niches in real estate. I did some building back in the early 90s, owned a brokerage, sold out to Coldwell Banker. That was around 2000. That led up to sort of what I call the debacle, the crash of '08, right? And what that did, why I wanted to get you there is what that did, the crash of '08, it really caused a lot of re-engineering in the business. And it's why and how we exist today, meaning I got out of that and said, all right, what are the things that I need to change or would like to change? And they were as follows. One, no signing personally on bank loans, like taking conventional loans out anymore, because I learned the hard way what happens when the market crashes. Two, as we talked about off air, let's work on, when I re-engineered it, I said to myself and my family, let's re-engineer this so that we work on a deal not being so transactional, if you will. Like, I built a home, I got a check. Good check, but had to do it again, right, to get that same check. Or a rehab, or as a broker, right? They were all transactional. So we trademarked what we call the 3 paydays. And when I keep saying we go out and buy real estate. We buy it without banks. We buy it creatively. But we also now teach that out in the field and have for, 12 years or so. And when I say teach it, as I said to you offline, we don't just sell things. What we do is we say, hey, let's lock arms. Let's do these deals together, because the biggest gap in real estate education is people not implementing, and mainly because they're afraid or don't have the support. And so that's what we do. The company Smart Real Estate Coaches now been on Inc. 5000, fastest growing companies for the last 3 years, because the model works. We're plain and simple. So I can go back to any piece of that, Brandon, but I just want to kind of give an overview for now.
Yeah, that's super helpful. So I guess if we can get down to the details of it, what is it that you're usually helping people with that they don't understand before they work with you, or they don't know how to do?
It reminds me, let me answer that by saying, because I always try to give real stories, it reminds me of my story. Like, I was in the business 18 years before pivoting to laser focus on creative real estate on your terms. Why? The answer is I don't know why I didn't at first, but the fact is that creative real estate right now, unbeknownst to most, is by far in 33 years under the most demand right now. And there's a bunch of reasons why. One, interest rates, right? Crazy interest rates right now. So many people got pushed to the side for buyers. That means sellers are having a tougher time. Two, we're at like the third time in 50 years where there's an affordability issue. All these things scream loudly and pull on the people that know how to pivot in the market for creative real estate, because I know for your listeners and your experience, everybody would agree that there's one constant in real estate, and that's that it keeps changing, right? And so many people go, well, I got to time this and I got to go in this geographic area. And the fact is you don't. You need to know how to pivot in up, down, or sideways markets, and you do that by becoming that sort of that transaction engineer that knows how to creatively pivot. And that's the best thing that you could do for yourself and your business right now.
Sure. Okay. Yeah, that's super helpful. I know that a lot of just like from speaking with our clients, I know that creative finance is obviously there's a lot of different things that can mean.
Yeah.
Right?
Yeah.
There's lots of different ways that you can do this. And I know that we have some clients that do focus on it quite a bit. And then for many, it seems to kind of be like the thing that you maybe pull out once in a while when you're not able to come to an agreement with a seller on price for a cash deal or something like that. It's kind of like that last trick up your sleeve when other stuff doesn't work. So anyways, with that context, can you help me understand like when you say creative, what exactly are you referring to? What are your favorite strategies, and how might it be different from somebody who's listening to this and saying, oh, creative finance, I got that. I do that already.
Yeah. No, I totally get it. So a couple things you said that are super important. I'll tie it all together. One is a lot of people in our community came to us because, say, they were wholesaling or flipping. And there's a lot of things that don't fit in that box that they throw away. Literally, like hundreds of leads that they throw away. So to your point, they can use the creative as a, hey, I'm capturing all these leads I was previously throwing away, like literally hundreds for a lot of wholesalers. Number one. Number two, what's neat is we, in our community, we do the opposite of what you said, Brandon. I lead all the time, every time with creative real estate. And what does it mean to us, to answer your question? One of three things, okay? Very niche down, because you are right. Creative can mean so many things within one deal. One is owner financing. We niche this down very specifically to owner financing with free and clear properties, so they have no mortgage. And we do so by making monthly principal-only payments. This is a huge sort of recession hedge, if you will. If you get a long enough term and you're paying principal only payments, I don't care what the market does. Literally do not care what the market does. So you have a chance to do 0% interest. And I was on a show recently and the host said, well, yeah, but the free and clear properties probably went down because of the interest rates and everybody took on HELOCs and whatnot. And I said, I better check my stat. Fact is, in the last decade, free and clear properties went from about 33% of the population, like literally 33%, to about 39.3%. So almost 40% of the properties in the United States are free and clear. Why not just go target or kind of fish in that pond? So that's how we do owner financing. And just to clarify this, you don't have to stay in the residential world. I bought my office building this same way, with no underwriting and no garbage that you have to go through the commercial grueling process if you had to go conventional. Second way we buy is sub 2. So next best thing to 0% interest is what? 2 or 3 or 4% interest? We're buying homes as recent as this week in Florida. I grabbed one at 2.6% interest, buying them subject to the existing loans. Plenty of people that are going, wow, I'm in trouble. I get this extra house, or doesn't matter how good the rate is, they got to get out. That's a very cool strategy right now, both of those. And then the third is very standard, good for a new person, lease purchase. I say good for a new person because our agreements have built into it like a $10 deposit, and you can tie up these properties, not own, but tie them up and control them. And I think the kicker here, Brandon, is sort of what a lot of creative people don't do, is we've trademarked that the 3 payday system, meaning when I do a deal, it's great to get paid once, like I said, transactionally, but the way I set it up, and I write about it in the book that your whole tribe can get, is they get now money. Everybody gets now money when they do a deal, but then that sets in motion sort of some continuous cash flow and then long-term cash out and wealth building. That's an ideal model. So you can get off the treadmill every few months or every few years and not feel like you got to be on this proverbial treadmill to keep earning the dollars, if that makes sense.
Yeah, that does make sense. So help me understand, like, really specifically, like, what these paydays are. Like, it sounds like you very specifically say, like, there are 3. Could you walk me through, like, let's just say an example deal. So it doesn't have to be a real deal, but, like, put some fake numbers in this, and let's just understand how this usually works.
Sure. So in my opinion, again, I'm pretty opinionated with the industry of education and real estate. There are a lot of public podcasts and YouTube videos right now with no names, I don't need to mention them, that'll come on and say, hey, we exit all our properties rent to own, and I don't care if the buyer ever gets qualified during the rent to own process because I get to go out and do it again and collect another check. And that, although that may be correct legally for them, morally and ethically it stinks, because what do we want to do when we exit all our properties rent to own? We want to make sure we set the buyer up to win and cash out the property and eventually own the property. So here's how the 3 paydays work then. I want to work with, Brandon, let's say that you're in a W-2 and because of COVID or personal reasons you left and you started your own business. I want to work with you because you're not bankable today, but yet you probably have good credit and you probably have some cash and you probably were ready to buy a house, but now you're not bankable. You can't start your own business and get a loan tomorrow. Banks, we're going to need 2 years of tax returns to get you qualified. So I work inside that realm with buyers that are true buyers that just need time. And the payday 1 comes in when they step up to the table like they were ready to do when they didn't know they couldn't get financing, and they put down a down payment. Somewhere between 5 and 10%, let's say, of the property I have. That's payday 1. That's now money. That's like that transactional piece. Payday 2 is the spread between the payment I'm making to the bank on that underlying loan that I'll never be on personally, remember, or the payment I'm making to the seller and what I'm collecting during the rent-to-own process. There's a delta there. That's payday 2. And I'll give you the numbers on this in a second. And then payday 3 is really cool because it's the cash increase in the price, the increase in the sales price, but it's also all of the principal pay down throughout the term of the deal. You cash that out at the end. All 3 paydays in our community range from a low of 45 grand to a high of 350,000 per deal. That's pretty lucrative. For our family business, myself and my son, it's about 75 grand per 3 paydays per deal. We're in the lower end just because of price range in New England. So that gives you an idea of how lucrative one deal can be. I wanted to throw that in there because I'll get a rehabber that calls me and says, I get like 6 of these a year from one rehabber, and he'll say, hey, Chris, I can't make heads or tails out of this deal. There's no money in it. But our 3 payday system can eke out, 6 figures all day long. That's a big difference for people that are not used to how to create those kind of dollars out of thin air, literally.
Yeah, that totally makes sense. One thing I've seen, and I'm curious how you combat this, and maybe this is just a weird question, but bear with me. Because one thing that we deal with often is we're trying to look at like marketing return on investment.
Yeah.
And it seems like everybody, when they're wholesaling, has an idea of how you calculate marketing return on investment. It's just, well, when we make 20 grand on the deal, then, and we spent 5 grand to get it, that's a 4x return, right? It's pretty simple. Once you get into like 3 separate paydays and the time value of money and stuff like that, it gets kind of messy. And what I've seen is that, in my opinion, a lot of our clients just kind of undervalue their creative deals because they're like, oh yeah, that's a deal and I'll make a lot of money on that eventually, but I'm not really making that much money now. And because of that, let's just not include that one in our return on investment, or let's just put it in at 10 grand, or whatever the case is. Like, do you deal with that problem commonly, or like, how do you recommend dealing with like comparing creative deals to other deals that you're doing in your business? And because this gets important even when we're going beyond just like the business owner making the decisions, to like the team making the decisions and the metrics that they're held accountable to, and the fact that they're trying to hit revenue numbers for the company. And like, I feel like there's just like some natural like apples to oranges kind of comparisons happening here, and how do you deal with that?
Yeah, see if this answers your question, because this is interesting that you bring it up. So if I do a deal, I'll use the deal I just did in Florida. So we're about to close on this. Buying it for, I'm going to use round numbers. We're buying it for $350,000 by taking on the property subject to the existing loan, and then giving the seller a little bit of equity in 4 years, no interest, no payments. How much am I going to spend to calculate my return on investment? How much am I going to spend to buy this house? 0 money down. But because we're giving them 0 money down, this young couple, we can expect them to pay their transfer tax, right? So we will have an expense of, let's just say $2,500 for a round number. Okay, on $2,500, what will we create for return on investment? Well, we'll get a down payment of about 10%. That's going to be about $40,000. That's day one. So let's just look at the first year. We'll create a monthly spread of about $500. So that's $6,000 a year. So in year one, on a $2,500 investment, if you will, to buy that house, we're going to pull in about $46,000. So in year one, if I compare it to anything else, it's not infinite, but it's very strong, right? You do the math. So, and then it just depends on when you cash it out. But the neat thing about the way we structure our 3 paydays is I can take a 4-year deal and turn it into a 10-year deal and turn it into a 20-year deal. I can do anything I want depending on what cash flow needs I'm encountering right then. I don't know if that helps your question with the ROI. I think I was tracking with you, but you tell me if I wasn't.
No, it does make sense. So one way that you're talking about is like basically how much money are we going to make in year one from the property, and comparing that to the other types of exits. I guess what I'm getting at is it feels to me that a lot of the companies we work with are kind of undervaluing their creative deals based on the fact that it takes a while to get the money, and like how you deal with that, which is interesting because you do creative mostly. How many of your deals are not creative, or are you just 100% creative with the deals
we
you do?
We do mostly creative. Now we'll make decisions internally. Brandon, we'll go, hey, it's about time we bring on a buy and hold. So recently I got with our assistant who's been with us for 9 years, and I said, hey, here's a zip code. I want you to mail postcards, which we don't do. We do all phone work, so we don't spend money unpredictably. But I'll pointedly say, hey, let's go grab a 4 to 10 unit. How do we do it? We buy a free and clear list of owners who are free and clear that have a 4 to 10 unit, and we'll go ahead and send those out. We'll look to do a buy and hold, right? But that's bought creatively still. It's just not exited right away. Most of our deals, if not all, are in the creative space for sure. I just have this aversion, Brandon, to, and this doesn't mean it's wrong. It's just what I came out of the crash knowing and believing and staying with, and that is I will not take out a bank loan and sign personally any longer. Maybe it's my age, maybe it's because I went through the crash, maybe it's all of the above, but I will not do it. So I tell my students not to do it. And now there are exceptions, of course there are. But that's how I tell everyone, just buy creatively, don't be signing on the personal guarantee line ever.
Yeah, that makes sense. That's super fascinating. So do you have any advice? Like, obviously this can get pretty complicated from the standpoint of the everything involved in the transaction, and you're working with these sellers. I think a lot of people don't lead with creative just because a lot of the other stuff is a lot more simple. and oftentimes is what the seller's asking for. In creative, like nobody goes. I would highly doubt that people are coming to you saying, I want to do some type of like creative finance solution to sell my house. Like more often than not, they probably want something like a cash deal, and then you're kind of showing them, you know, the value of what you do with creative. So can you help me understand like what that conversation looks like with the seller and how you take this like complicated thing and make it easy for them to understand?
Yeah. Very good question. So my conversation goes like this. I mean, I had one right before this call, right before this interview. My conversation goes, hey, Brandon, I see you want X. If I can get you full price, are you open to doing that over time via owner financing or lease purchase? And they'll say, well, no, I want to sell. I get it. 99% of the homes I buy, the sellers want conventional, full price cash. I say it kind of facetiously, but then I add the but. And the but is right now, if you talk to top producing mortgage brokers, and I share this with the seller, about 17 to 20% of the applicants can get a loan today. That's low. That's a very low pool of buyers. So if you don't get full price in the time you want, and you don't need your cash today to go buy another home, I'm a great plan B. And so that's where we get all our leads. And that's been the case for the last, again, 12 or 13 years. You'd be surprised, though, to your earlier point, like some sellers do seek out owner financing from a buyer. My building, I bought in November of 18. I just sold it recently, but I bought it in November of 18. And he said to me in frustration, hey, Chris, I have brokers coming to my door saying, hey, I have buyers. He said, they don't understand it. I want owner financing for estate and planning reasons and tax reasons. Like some intelligent, sophisticated owners of single families, multis, and commercial want and require owner financing for personal reasons. So there's that component. And the other component is we're doing a deal right now. Again, I'm doing all current stuff this week. A student called me at 8 a.m. this morning and got me on the phone with a seller, because that's what we do. We help with that. It's a young couple. It's a sad story, but they have to get out of the house and they're 3 months behind. They don't have a choice. Their credit's already beat up. If they let it go, as you know, they're going to be beat up for 3 to 7 years. We're going to come in, cure the arrears, and buy that subject to. That is a gift to them, for sure. So there's all those moving parts. There's the free and clear person that wants creative and wants all their money. And then there's the person on the other end of the spectrum that is in dire needs and needs you to come in and understand how to structure that. So we do both.
Yeah, that totally makes sense. Well, thank you for sharing some of this, Chris. It's super fascinating. So I understand that you have a book, right? That people, if they want to learn a little bit more about this, they can somehow get.
Yeah. So we don't do, I'm going to talk about the industry again and poo-poo on that a little bit, because a lot of times I'll personally look for a book offer, right? And I get all the way through to the screen where I put my address in and it says, okay, pay $8 for shipping. I'm like, I thought it was free. So we will send you for free, no shipping, we have 4, but one of our best-selling books, which describes sort of what you and I have been talking about. It's called Real Estate on Your Terms. Just go to Wicked Smart Books with an S, wickedsmartbooks.com/Bateman and the number 1, the numeric number 1. And we'll ship that out to you. And then you and I were chit-chatting before the show. We do have our annual live event. We've done this since 2016 when we were in a basement of a Chamber of Commerce. And now it's done at a larger scale. That's in Boston, Massachusetts, September 23rd and 24th. You can just go to qlslive.com for information on that.
Very cool. Thank you, Chris, for your time and generosity and sharing all your insights today. And for everybody else listening, I'll see you next week.